Welcome to Talk Tickers. We're here to cut through the noise of the headlines, bypass the Twitter sentiment, and, well, get straight to the mechanics of the market.
Exactly.
We don't do fluff, we don't do hype, and we certainly don't do surface-level skims. You are tuning into Talk Tickers, which means, we usually spend our time summarizing professional earnings calls and financial data. We take that stack of documentation, the earnings transcripts, the regulatory filings, the technical papers, and we distill it down to what actually moves capital.
Right. We look for the signal in the noise. And today, that signal is coming from a direction that I think most people usually tune out, which is Brussels.
Yeah, Brussels. Today, we are focusing on an incredibly important financial topic. We are doing a deep dive into the EU taxonomy for sustainable activities. Now, I know what you're thinking. Taxonomy. I'm here for alpha, not a biology lesson, but stay with us.
It is a dense topic, definitely. But you're right to highlight it right at the top. If you are a sophisticated investor operating in global markets today, you simply cannot ignore this.
No, you can't.
This isn't just about, a nice-to-have ESG badge or some corporate marketing gloss. This is a massive capital reallocation tool. It is designed, quite literally, to shift the entire European economy and, by extension, the global supply chain toward net zero.
And that is the hook right there.
Yeah.
I think a lot of people, when they're listening to an earnings call and they hear the CEO mention the EU taxonomy, they just hear red tape. They think compliance costs, legal fees, headaches.
Right, a box-ticking exercise.
Exactly.
Yeah.
But what we are seeing in the source material we've reviewed is that this is effectively the new gold standard dictionary for capital markets. It is defining with absolute legal precision what counts as green and what is merely marketing.
That is the perfect way to frame it, a dictionary. Because, think about where we were maybe 5 or 10 years ago. We lived in a world of vague adjectives.
Oh, completely.
A company could paint their logo green, they could launch a minor recycling initiative in the corporate cafeteria, and suddenly they call themselves a sustainable leader on their Q3 call.
Or a fund manager could buy a massive tech stock that just happens to be carbon neutral because, it has no factories. It just writes code. And they slap a green fund label on the prospectus.
It was the Wild West.
The era of greenwashing.
Exactly. The EU taxonomy ends that. It moves us from a world of adjectives, words like green, eco-friendly, sustainable, to a world of hard, comparable metrics. We are talking about turnover, CapEx, and OpEx alignment. These are actual numbers you can put into a discounted cash flow model.
And that transition from adjectives to math, that is where the opportunity lies for you as an investor. We aren't here to moralize about saving the planet today.
No.
If you want moralizing, go to a different show. Our focus today is strictly on the mechanics of capital flow, regulatory arbitrage, and identifying the alpha in the transition from what the regulators call eligible activities to aligned activities.
It's really about understanding the rules of the game so you can position your portfolio accordingly, because the rules have fundamentally changed and a lot of the market just hasn't updated their playbook yet.
So let's unpack this. We need to start with the mechanics. What exactly is the taxonomy? I mean, is it a law? Is it a mandatory list of what you have to buy?
At its core, the EU taxonomy is a classification system. It is a list, a very long, highly detailed, scientifically based list of environmentally sustainable economic activities. It covers everything from, manufacturing cement to writing software, from generating power to driving freight trucks.
And I think this is crucial for our listeners to understand. It is not a mandatory list of things you must invest in. The EU isn't knocking on a major asset manager's door and forcing them to buy wind farms.
Correct. It is a transparency tool. What it does is translate the broad, fuzzy concept of sustainability into financial key performance indicators, or KPIs.
So you can still buy what you want.
Absolutely. You can still invest in coal. You can still invest in oil sands. The taxonomy doesn't make those illegal. But if you want to market a financial product in Europe as sustainable, or if you are a large company reporting your non-financial data, you have to use this dictionary. You have to disclose exactly how much of your business matches the strict criteria on this list.
Okay, so it's a list. But getting on that list, actually qualifying, is not easy. The information we reviewed describes a 3-step test for alignment. This seems to be where the rubber meets the road. If a company wants to claim their revenue is taxonomy aligned on an earnings call, they have to jump through 3 hoops simultaneously.
And missing even one of those hoops means you are at zero. You get absolutely no credit. There is no partial credit in the taxonomy. You are either aligned or you are not.
Walk us through that gauntlet. What is step 1?
The first condition is substantial contribution. The activity has to make a significant, measurable positive impact on at least one of the EU's 6 environmental objectives. This is usually the part everyone focuses on. If you are building a solar panel factory, you are likely making a substantial contribution to climate change mitigation. If you are retrofitting a commercial building to be vastly more energy efficient, you are contributing.
That seems pretty straightforward. If my company is actively reducing carbon emissions, I'm in.
Not quite. That's only step 1. That just gets you in the door. Step 2 is where it gets incredibly tricky and where we see most companies actually fail right now. It is called do no significant harm, or DNSH.
DNSH. This is the holistic filter.
Right. The logic here is simple but brutal. You cannot solve one environmental problem by creating another one. While your economic activity is helping one objective, it absolutely cannot hurt the other 5.
Can you get us a concrete example of that? Because I think this is where that red tape complaint usually comes from when we listen to corporate feedback.
Sure. Let's take a hydroelectric plant. On paper, it generates renewable energy. So it passes step 1 effortlessly. It makes a substantial contribution to climate mitigation because it's carbon-free power. Great.
Right.
But does that massive dam destroy the local river ecosystem? Does it prevent natural fish migration? Does it cause severe sedimentation downstream?
So under the taxonomy rules, the company has to prove that it doesn't do any of those things.
Yes. If that hydro plant impacts the local biodiversity negatively, it fails the do no significant harm test regarding the protection of biodiversity. And therefore, under the taxonomy, that entire hydro plant is not aligned. It counts as 0.
Wow. That is an incredibly high bar. You effectively have to prove a negative across multiple environmental dimensions.
It requires a level of granular asset-level data that most companies simply did not collect 5 or 10 years ago. You need environmental impact assessments for water usage, for circular economy impacts, for pollution prevention.
And then there's the third step.
Minimum safeguards. This step leaves the environment entirely and looks at social governance. The company must comply with the OECD guidelines for multinational enterprises and the UN guiding principles on business and human rights.
So we are talking about labor rights, essentially.
Mostly, yes. No forced labor, no child labor, no union busting, and it also includes proper corporate tax compliance and anti-corruption measures.
That's a huge caveat.
It is. Think about it. You could have the absolute greenest technology in the world, let's say a state-of-the-art electric vehicle battery factory with 0 emissions and a perfect closed-loop recycling system.
Sounds like 100% aligned activity.
You'd think so, but if you were using forced labor in your supply chain to mine the cobalt for those batteries, or if you were violently busting unions in your assembly plant, you fail the minimum safeguards. You are not taxonomy aligned. 0%.
So it's a 3-part filter. Do good, don't break anything else while you're doing it, and treat people right. It prevents a company from solving one problem while creating 2 others. Now, you mentioned the 6 environmental objectives earlier. We should probably list those out for you, the listener, because the scope here is way broader than just carbon emissions.
This is a really key point for market participants to grasp. Most investors today focus purely on the first 2 objectives because they were rolled out first back in 2021 and 2022. Those are climate change mitigation, which is just reducing greenhouse gas emissions, and climate change adaptation.
Adaptation is an interesting one. That's things like building seawalls or developing drought-resistant crops.
Exactly. It's about resilience to the climate changes that are already locked in. But the regulation didn't stop there. It expanded. In 2023 and 2024, the framework brought in the remaining 4 environmental objectives.
Which are?
They are the sustainable use and protection of water and marine resources, the transition to a circular economy, pollution prevention and control, and the protection and restoration of biodiversity and ecosystems.
That circular economy objective is fascinating to me from an earnings perspective.
Yeah.
That pulls in a lot of manufacturing and waste management sectors that might not have been captured by pure carbon metrics.
It fundamentally changes how we have to look at sectors like consumer electronics or fast fashion or even packaging. Suddenly, concepts like the right to repair, product durability, and recyclability become hard financial metrics.
So if I'm a tech company,
if you make a smartphone that is glued shut, uses proprietary screws, and literally cannot be repaired by the consumer, you might completely fail the circular economy contribution criteria. even if your entire assembly plant runs on 100% wind power.
It reaches right into the product design phase. It's not just about how you power the factory, it's about what the factory makes.
It does. It forces corporate R&D departments to align directly with the regulatory framework if they want access to sustainable capital.
All right, let's talk about the data. How is this actually measured? If you're an analyst and you're digging through a company's annual report or listening to their year-end earnings call, what specific metrics are you looking for?
This is crucial for portfolio construction. Companies that fall under this regulation have to report their alignment based on 3 specific financial metrics. First, there is turnover,
Which is just European regulatory speak for revenue.
exactly revenue. Turnover tells you how much of the money the company made today is coming from green activities. It measures the greenness of the company right now in the present moment.
Okay, so if I'm looking at a pure play renewable energy company like a solar developer, their turnover alignment might be close to 100%.
Assuming they pass the DNSH and social safeguards, yes.
But for a massive legacy utility company that still runs coal plants alongside some new wind farms, their turnover alignment might only be 15 or 20%.
Exactly. Turnover is a snapshot of the present. But if you want to find the alpha, if you want to find the future growth, you look at the second metric, CapEx, or capital expenditure.
This is the forward-looking metric.
Arguably the most important one for investors. CapEx alignment measures how much the company is actively investing into green assets, or how much they are spending to upgrade their existing dirty assets to meet the green standards. This tells you the greenness of the company's future strategy.
That is a massive distinction. Let's apply that. Take a traditional steel manufacturer, a heavy industry player with blast furnaces. Their turnover alignment today, right now, is probably 0, right?
Likely 0, or very, very close to it. Making traditional steel is highly carbon intensive.
But if that same steel company announces on their earnings call that they're spending $2 billion retooling those blast furnaces to run on green hydrogen or installing massive electric arc furnaces, their CapEx alignment for that year could be huge.
It could be 60%, 70%, even higher. And that right there is the signal. If you see a company with very low turnover alignment, but very high CapEx alignment, that is a company in transition. They are aggressively reallocating their capital to survive and thrive in a net zero world.
Versus a company with 0 turnover alignment and 0 CapEx alignment.
That is a company that is slowly liquidating its own future. They aren't pivoting. They are just running down their legacy assets until they become stranded.
Wow. And then there's the third metric, OpEx.
Operational expenditure. This covers maintenance, R&D costs, short-term lease agreements, the day-to-day spending associated with keeping green assets running. It generally tracks closely with CapEx, but the absolute numbers tend to be smaller. It's essentially a good sanity check to see if the operational side of the business is actively supporting the green asset base.
I want to drill down on a concept that came up repeatedly in our research stack for this deep dive, and it's the distinction between eligibility and alignment. This seems to be the single biggest trap for investors right now. I see funds out there marketing themselves as having, say, high taxonomy exposure, but when you dig into the filings, it's almost entirely eligibility.
It is the defining feature of the current market data, and it is exactly where retail investors and even some institutional folks get misled. Here is the fundamental difference. Taxonomy eligible simply means your industry is on the list.
It just means the taxonomy has an opinion on your sector.
Correct. For example, manufacturing cement, driving freight trucks, generating electricity, hosting data centers. These activities could be green, theoretically, if they are done perfectly. Being eligible just means you are in the game. It says absolutely nothing about your actual environmental performance.
So practically every cement company in the world is taxonomy eligible.
Yes, because manufacturing of cement is a recognized listed activity in the rulebook.
But unless that specific cement company has drastically reduced its emissions intensity to meet the exact threshold and pass the do no harm tests, it is not aligned.
Exactly. Taxonomy aligned means your specific economic activity actually meets the strict technical screening criteria, passes the do no significant harm test, and meets the minimum safeguards.
So eligibility is just showing up for the tryout. Alignment is actually making the team.
That's a perfect analogy. And here's the trap for you as an investor. A fund might market itself heavily as having 40% taxonomy exposure, but when you look under the hood at the actual reporting, that might mean 40% eligible exposure, the actual aligned exposure. The amount of revenue that is genuinely green, according to the law, might be only 3%.
That is a massive, massive gap. 37% of that portfolio is effectively dirty companies operating in the sectors that could theoretically be clean someday.
Or, to be fair, companies that just haven't done the incredibly complex paperwork yet. But yes, for the investor, that gap represents risk. You are paying a premium for green exposure, and you are only getting potential exposure.
We're going to talk about the arbitrage opportunity in that gap later in the show, what we call the alpha play. But first, let's back up a bit and look at the history. How did we end up with this massive 500-page regulatory rulebook in the first place?
It definitely didn't happen overnight. It all started back with the 2018 Action Plan on Financing Sustainable Growth. The EU policymakers sat down, crunched the numbers on the Paris Agreement and their own European Green Deal, which has a legal target of net zero by 2050, and they realized they had a severe math problem.
They simply couldn't afford it.
Not with public money, no. They calculated they needed roughly 180 billion euros a year in additional investment just to hit the 2030 targets, let alone 2050. They realized very quickly they needed to reorient massive amounts of private capital flows. They needed the pension funds, the insurers, and the asset managers to foot the bill.
But the hurdle there was trust.
The hurdle was fragmentation and, as we discussed, greenwashing. Before the taxonomy, green meant whatever a corporate marketing department decided it meant. You had a situation where a green fund marketed in France looked completely different, held completely different assets than a green fund marketed in Germany. Market fragmentation was incredibly high. Investors couldn't compare apples to apples. They couldn't verify the claim, so they held their capital back. The risk of reputational damage was too high.
So the regulators needed a dictionary to standardize the language across the entire continent to unlock that private capital.
Exactly. And so the taxonomy regulation formally entered into force in July 2020. Then came the delegated acts. These are the deeply detailed technical rules outlining the exact emissions thresholds in 2021 and 2022 for the two climate objectives.
And it hasn't exactly been smooth sailing. We have to address the massive controversy regarding the inclusion of nuclear energy and natural gas. Because looking back at the news from 2022, this was a massive political street fight.
Oh, it almost derailed the entire European project. You had France, which gets most of its power from nuclear, pushing incredibly hard for nuclear to be included. You had Germany and several Eastern European nations pushing for natural gas to be included as a necessary bridge fuel to get them off coal. Meanwhile, the environmental purists and several other member states were screaming that neither of those belonged anywhere near a green taxonomy.
Now, we aren't taking sides on the energy mix here. We're just looking at how the regulation handled it. So what was the final compromise?
In late 2022 and 2023, the EU made the highly controversial decision to include both of them, but they labeled them specifically as transitional activities. This is a very important nuance for investors. They are not treated exactly the same as a wind farm or a solar array. They are flagged.
Let's break that down. Nuclear is included, but with conditions.
Very strict, almost punishing conditions. To be aligned, a nuclear facility requires comprehensive plans and secured funding for the safe disposal of high-level radioactive waste to be fully operational by 2050. That is a massive technical and political hurdle for any nation. It also requires the use of, quote, best available technology for new plants. It is legally recognized as a low-carbon energy source that is necessary for baseload power, but the barrier to entry for actual alignment is incredibly high.
And what about gas? How do they justify that?
Gas is even more restricted. It is included purely as a transitional fuel to replace much dirtier coal plants. But it comes with very strict emissions caps, specifically 100 grams of CO2 equivalent per kilowatt hour for new plants. And crucially, it includes a sunset clause.
A sunset clause meaning they have to shut them down.
Meaning the facilities effectively have to switch entirely to low carbon gas or green hydrogen by 2035.
So it's not a permanent pass. It really is just a bridge.
It's a bridge that burns down behind you have to move.
And despite this inclusion, as we will see in the data section coming up, the actual alignment numbers for major oil and gas companies remain virtually at zero.
That's the great irony of that whole political fight. The technical criteria for gas are so unbelievably strict that almost no existing natural gas plant meets them today. So while gas is technically in the rule book, practically speaking, it's mostly out in terms of current reported alignment numbers.
Now, the EU obviously moved first on this. That is the classic Brussels effect. They set the massive regulatory standard, and the rest of the world kind of have to adapt if they want to sell products or raise capital in that market. But what is happening internationally are other major players following suit.
China is the other really big player here. China actually has its own system called the Green Bond Endorsed Projects Catalog. It is essentially their version of the taxonomy.
And are Brussels and Beijing actually talking to each other about this? Because global capital hates fragmentation. If I have to check two completely different rule books, that slows everything down.
They are talking. There's a very important ongoing project called the Common Ground Taxonomy, or CGT. The EU and China are systematically mapping their two systems together to find the overlaps. And they found about 72 climate mitigation activities that overlap significantly.
That is huge for global capital flows. It means if I'm a portfolio manager sitting in London or New York, I can buy a Chinese green bond and know with some certainty that it meets a standard fairly comparable to the EU one without having to do double the due diligence.
Exactly. It reduces the friction for cross-border capital. It aims to create a fungible, universally understood definition of green across the two largest markets. And we are seeing other jurisdictions. The UK is drafting one, ASEAN nations have one, even Russia has built one, and they are often using the EU model as their baseline template.
So the EU has effectively exported its definition of green.
They really have. The U.S. is obviously taking a completely different approach with the Inflation Reduction Act, which is all incentives, all tax carrots, no regulatory sticks. But regarding the actual classification of what is green, the EU wrote the dictionary.
Let's pivot to the investor context. This is where the rubber meets the road for you listening. We need to talk about the SFDR, the Sustainable Finance Disclosure Regulation. If you listen to European earnings calls, you hear these two acronyms, SFDR and taxonomy, paired together constantly. How do they actually interact?
The easiest way to think of it is this. The SFDR is the disclosure regime. The taxonomy is the dictionary. SFDR tells you that you have to speak up and report. The taxonomy tells you exactly what words to use when you do.
So SFDR categorizes the investment funds themselves.
Right. Under SFDR, you have Article 6 funds, which have absolutely no sustainability scope. They just buy whatever. Then you have Article 8 funds, which promote environmental or social characteristics. The market often calls these light green funds. And finally, you have Article 9 funds, which have an explicit primary sustainable investment objective. These are the dark green funds.
And what is the compliance link to the taxonomy?
If you are a manager running an Article 8 or an Article 9 fund, you must disclose your taxonomy alignment to your investors. You have to look through your entire portfolio, aggregate the alignment of all the underlying companies, their turnover and their CapEx, and report that final percentage number.
And this brings us to the data reality check. The source material we analyzed looked at recent market data out of the DACH region, Germany, Austria, Switzerland, and the Nordic regions. Now, these are generally considered the most progressive, deeply green-focused markets in the world. The numbers they are reporting are, well, they're stark.
They are surprisingly, almost shockingly low. The average taxonomy-aligned turnover in European sustainable funds right now is roughly 3.3%. And that is based on reported data.
3.3%. Let that sink in. That implies that even in Northern Europe, which is leading this global charge, the actual corporate economy is barely green by these new standards.
Correct. Even when data providers use combined data, which means they include their own estimates for companies that haven't formally reported yet, the average only rises to about 7%.
So why is it so low? Is the economy really just that dirty, or is the measurement system broken?
It's a combination of three major factors. First, the criteria are genuinely aggressively strict. We are talking about best-in-class performance here, not just slightly better than the industry average. Second, there is a massive lack of data availability. Many underlying companies, especially smaller cap ones or companies headquartered outside the EU, simply aren't tracking or reporting this specific data yet.
And the third factor?
The do no significant harm check. As we discussed, it is very hard to verify at scale without incredibly granular data. If a fund manager cannot definitively prove that a holding passes the DNSH criteria across all objectives, they often have to default that position to 0% just to be legally safe.
The market reports also mentioned a zero phenomenon. What is that?
Yes. Currently, over 16% of sustainable funds report exactly 0% alignment. Now, this doesn't necessarily mean they are secretly holding nothing but coal mines and oil rigs. It often means they have massive data gaps from their portfolio companies, or they just haven't performed the incredibly expensive assessment yet. It's a reporting zero, not necessarily a performance zero.
But for you as an investor, a zero is a zero. If I'm allocating capital to an Article 9 fund looking for pure green exposure and you report a zero to me, I'm taking my money and walking away.
Exactly. And that is why the pressure is mounting so heavily on the underlying companies to report properly. If you are a genuinely clean, efficient company, but you are lazy with your taxonomy reporting, you are going to get priced by the market like a dirty company.
Let's break this down by sector.
Yeah.
Because it's not evenly distributed. Who are the winners and losers here?
The clear winners right now, the sectors showing the highest alignment, are utilities, specifically power generation and construction.
Why them?
It comes down to capital intensity and clarity. It is very easy to mathematically measure if a wind farm generates green electrons. The technical criteria for renewable energy are extremely clear. Construction is similar. The energy efficiency standards for new buildings are well defined by local laws. Plus, these sectors have massive CapEx needs, so they naturally align with the taxonomy's focus on capital transition.
And the laggards. The sector struggling to show any alignment.
Healthcare, biotechnology, and chemicals.
Pharma. Really, I wouldn't naturally think of a biotech firm as a dirty industry.
They aren't dirty in the traditional sense of smokestacks and coal ash, but they struggle with the taxonomy for two big reasons. One, their specific economic activities just might not be well covered in the climate delegated acts yet. The rules focused on heavy emitters first. Two, meeting the strict circular economy and pollution prevention rules is incredibly difficult for chemical-intensive industries. It is very hard to manufacture complex pharmaceuticals at scale without creating somewhat toxic chemical waste.
That makes total sense. It really highlights that green isn't just about your carbon footprint anymore. It's about the whole life cycle of the molecule. And we touched on oil and gas earlier. Even with that transitional label they fought so hard for, their actual alignment is near zero.
It is. The emissions thresholds to qualify as transitional are just too tight for current commercial technologies. An oil major would need massive, unprecedented deployment of carbon capture and storage to even come close to aligning their natural gas assets.
Okay, I want to go back to that alpha play we teased earlier, because this is the core for active managers.
Right.
The gap between eligibility and alignment.
This is truly the most actionable insight to pull from this regulation. Market data shows that, on average, about 40% of fund portfolios are taxonomy eligible. That means 40% of the invested money is sitting in sectors that could be green transport, energy, manufacturing, real estate.
But only 3% is actually aligned.
Right. That gap, 40% eligible minus 3% aligned, is the transition opportunity. There is a huge swath of public companies out there that are operating in the right sectors but haven't done the work to prove they are green. Maybe they need to upgrade a specific factory. Maybe they just need to hire consultants to sort out their reporting on do no significant harm.
So if you are an active fund manager, you screen for those companies. You find the mid-cap manufacturer that is highly eligible but currently not aligned. You engage with their management team. Maybe you provide the exact capital they need for that factory upgrade, or you just wait for them to finally file the proper paperwork.
And when they finally do file it, their green asset ratio spikes. They go from 0 to 40% aligned overnight. Suddenly, they pop up on the quantitative screens of every single Article 9 fund in Europe. Massive passive capital flows in, and the stock gets re-rated. That is the alpha. You are essentially arbitraging the regulatory data gap.
That is fascinating. It's not just buying the obvious winners like pure play solar. It's buying the potential winners before the data catches up.
It is buying the transition. And the CapEx numbers give you the exact clue you need. If you see a company with low turnover alignment, say 5%, but a high CapEx alignment, say 50%, they are screaming at you through their financial statements, we are transitioning.
One final point on the investor context here, eco-labels. We have SFDR, which is the disclosure rule. But we also see funds marketing themselves with things like the Austrian eco-label or the Nordic Swan label. Do those actual consumer labels matter to institutional investors?
They do, surprisingly. The data clearly shows that funds possessing these specific, rigorous eco-labels have significantly higher taxonomy alignment, often double or triple the broader market average.
Why is that?
These labels act as a proxy for much higher data quality and much stricter internal portfolio screening. If you see a fund with the Nordic Swan label, you can generally assume the manager has done the homework and the underlying alignment numbers are real and verified, not just estimated.
All right, we have covered the core mechanics, the fraught political history, and the trading strategy. Now it's time for the one question. If you, our listener, are on a due diligence call with a fund manager, or maybe you're analyzing a CFO's presentation, what is the single most important question you need to ask to cut through all this noise?
The question is this: what is the exact ratio of your portfolio's taxonomy eligibility to its taxonomy alignment?
That is sharp. And why does that specific ratio matter more than just the headline number?
Because it exposes the execution gap. It tells you immediately whether you are holding companies that are actually green today, which would be high alignment, or if you're just holding companies sitting in green-sounding sectors that haven't done the hard work to prove it. A high eligibility but low alignment ratio means you are betting on potential. Or worse, you're relying on vague corporate promises. High alignment means you are buying verified performance. You just need to know which of those two bets you are actually making.
That is the signal. High eligibility, low alignment, that's a transition bet. High alignment, that's a pure green bet. Know the difference.
Exactly. Don't let their marketing department blur those lines for you.
Let's wrap this up with our key takeaways for the episode.
Takeaway 1. The taxonomy is a living dictionary. It is not static. It is actively expanding to new environmental objectives. And the technical criteria will naturally tighten over time as technology improves. You cannot learn this rulebook once and forget it.
Takeaway 2. Adjust your expectations immediately.
Yeah.
3% alignment is the current reality of the market. Do not expect even the best green funds to be 100% aligned. The global economy simply isn't there yet. If someone pitches you a fund claiming 80 or 90% alignment, check their math very closely. They are likely concentrating your risk into an incredibly tiny sliver of the market, like just 3 pure-play wind companies.
And takeaway 3, watch the CapEx. Turnover tells you who is green today. CapEx tells you who will be solvent and profitable in a net zero 2050. That is exactly where the future value is hiding.
And a final disclaimer from us, everything we discussed today is for informational purposes. The market data we cited is largely based on European fund analysis, specifically from the DACH and Nordic regions, and these reporting standards are evolving rapidly month by month.
The reported numbers will absolutely change as corporate data collection improves.
I want to leave you with one final thought to mull over. We've talked mostly about public equities and mutual funds today, but what happens when this taxonomy starts dictating the cost of private debt? When a major European bank looks at your company and refuses to roll over your loan because your CapEx alignment is 0 and it's dragging down their own green asset ratio. That is the next frontier of this regulation, and it is going to catch a lot of private companies off guard. This has been Talk Tickers. We hope you feel a little more equipped to navigate the green transition. Good luck out there.